Nobody asked XRP for permission. Not the banks, not the regulators, not the analysts who've been wrong about it for 7 years straight. And here's the thing that keeps me up at night. The institutions who spent the last decade calling this a toy, they're not arguing anymore. They've gone completely silent. And in finance, silence doesn't mean defeat. It means acquisition. It means they've already moved, and they don't want you moving with them. Today, I'm going to show you a pattern that's quietly repeating itself in the data right now. A convergence of on-chain activity, regulatory architecture, and institutional flow mechanics that the mainstream crypto space is completely misreading. Not because they lack the data, because they're looking at the wrong clock. Welcome back to XRP News Flow Signals, where we cut through the noise and follow the structure. I'm not here to hype you, and I'm not here to scare you. I'm here to show you what the data actually says when you strip away the emotion. As always, none of this is financial advice. Do your own research, consult professionals, and make decisions that fit your own situation. Now let's get into it. Let me start with a hard truth that most people in this space aren't ready to hear. The reason XRP's price looks confusing right now, hovering, consolidating, frustrating patient holders, has nothing to do with weakness. It has everything to do with architecture. Here's what I mean. When a building goes up, the longest, most unglamorous phase isn't the ribbon cutting. It's not the glass going on the facade. It's the foundation work. The months where all you see from the street is a hole in the ground and a lot of trucks moving dirt. That's the phase that determines whether the structure stands for 100 years or collapses in the first storm. The XRP Ledger right now, it's in the trucks and dirt phase. And most retail investors are standing on the sidewalk complaining that nothing's happening. Think about what's actually being built underneath. Ripple's acquisition of Hidden Road, a prime brokerage firm that clears over $3 trillion in transactions annually, didn't happen because someone had a good feeling. That acquisition places XRP infrastructure directly into the clearing and settlement layer that institutional counterparties already use every single day. This isn't a partnership announcement. This isn't a white paper. This is operational infrastructure. Simultaneously, Ripple's integration with tokenized funds, including direct bridges to BlackRock's own BUIDL product, means XRP isn't waiting to be invited into institutional finance. It's already inside the building. David Schwartz, the chief technology architect behind the XRP Ledger, has been consistent about one thing for years. The ledger was built for the settlement of value at institutional scale, not retail speculation. When you understand that design philosophy, the current price range doesn't look like stagnation. It looks like a loading bar. And here's what makes this moment different from every other cycle. The nostro vostro problem. The $27 trillion in trapped capital sitting idle in pre-funded correspondent banking accounts around the world right now is not theoretical. It is the single most expensive structural inefficiency in global finance. And it is the specific problem XRP's on-demand liquidity rails were engineered to solve. The banks know this. They've known it for years. The question was never whether. It was when the regulatory floor would be solid enough to move. That floor is being poured right now, and the trucks are still moving. Let's talk about the math that the crowd consistently ignores. Not because it's hidden, but because it requires patience to sit with. The global cross-border payments market moves approximately $150 trillion annually. That's not a forecast. That's current volume. The Forex market alone clears $7.5 trillion every single day. These are the rails that are slow, expensive, and fragmented. And the institutions currently running those rails, your correspondent banks, your clearinghouses, your currency intermediaries, are not sentimentally attached to the old system. They are attached to their margins. When a faster, cheaper, more transparent alternative emerges with regulatory clarity behind it, the math changes instantly. Here's the calculation that matters. If XRP captures a conservative 1% of annual cross-border settlement volume. 1%. You're talking about $1.5 trillion in flow needing to move through a fixed supply of approximately 57 billion circulating tokens. Not 100 billion, 57 billion, because the rest is locked in escrow, burned through transaction fees, or sitting in wallets that haven't moved in years. Now layer on the deflationary mechanic. Every single transaction on the XRP Ledger destroys a small amount of XRP permanently. Not redirected, not recycled, gone. At the current rate of 2.7 million daily transactions, a number that is rising, the supply isn't just fixed, it is actively shrinking. The math on that isn't a prediction. It is a design requirement baked into the ledger's original architecture. And then consider what Ripple's own projections out of their Tokyo summit indicated. $33 trillion in projected on-chain volume by end of 2026. Even if that number is off by 80%, you're still looking at a volume-to-supply ratio that the current price does not reflect. That gap between current price and structural requirement is not a mystery. It is an opportunity that closes quietly, without announcement, for the people tracking the right metrics. Ask yourself the brutal question: if you wanted to build a system that could handle trillions in value transfer daily, what would it need? Speed. XRP settles in 3 to 5 seconds. Cost efficiency. Fractions of a cent per transaction. Fixed, transparent supply. No central bank can inflate it. Regulatory survivability. 7 years of legal pressure, and it's still here, cleaner than ever. This isn't a moonboy fantasy. It is a logical engineering requirement for the system global finance is being forced to build. And look, if you're sitting here connecting these dots for the first time, or even the 10th time, but finally seeing the full picture come together, that feeling you have right now, that's not hype. That's pattern recognition. That's what separates the people who are early from the people who are late. If you want to keep following this structure in real time, the on-chain signals, the institutional filings, the ledger metrics before they make mainstream headlines, subscribe to XRP News Flow Signals right now. Hit that bell so you don't miss a single update, because these windows don't announce themselves. The next briefing could be the one that reframes everything you thought you knew. Subscribe. Let's keep building this together. Now let's talk about what the smart money is actually doing, because this is where the retail versus institutional divide becomes impossible to ignore. While social media spent the last several weeks debating short-term chart levels and macro noise, a very different story was unfolding in the filings. XRP-focused investment vehicles have now crossed $1 billion in cumulative assets under management. These aren't retail ETFs driven by social media momentum. These are structured institutional products, the kind that require legal teams, compliance sign-offs, and board approval before a single dollar gets allocated. Goldman Sachs has surfaced as a top holder in XRP-linked vehicles. Let me be clear about what that means. Goldman Sachs does not allocate capital to experimental assets. They allocate capital to infrastructure they are certain will exist in 10 years. Meanwhile, XRP inflows hit $119 million in a single week, the largest weekly figure since December, pushing year-to-date totals past $159 million. That happened while Bitcoin sentiment was mixed and Ethereum was navigating its own narrative headwinds. That is not rotation into hype. That is rotation into specific, utility-anchored conviction. On the regulatory architecture side, the Digital Asset Clarity Act is progressing, and for the first time, we have genuine legislative language that distinguishes commodities from securities in a way that creates a clean, compliant lane for XRP's existing use case. Japan's FSA has already provided that clarity domestically. The EU's MiCA framework is operational. The global regulatory floor is not being debated anymore. It's being poured, jurisdiction by jurisdiction. And Ripple's own balance sheet moves reinforce the thesis from the inside. Their $500 million strategic raise, backed by Fortress, Citadel Securities, Pantera, and Galaxy Digital, valued the company at $40 billion. Citadel Securities is not a venture bet shop. They are a market-making and trading infrastructure firm. When Citadel backs the rails, it tells you exactly what direction institutional liquidity is about to flow. The institutions are not waiting for confirmation. They are the confirmation. The retail crowd is still asking if. The smart money already moved to when. So what's the trigger? What specifically should you be watching in the weeks and months ahead? First, the stablecoin and market structure bills moving through the U.S. legislature. These aren't abstract policy discussions. They are the final piece of the regulatory architecture that unlocks institutional participation at scale. When these pass, and the language on both has moved further in the last 60 days than in the previous 3 years, the legal ambiguity that kept pension funds and sovereign wealth vehicles on the sidelines disappears. Second, ODL corridor expansion. On-demand liquidity volume has been quietly growing in Southeast Asia, the Middle East, and Latin American corridors where the pain of correspondent banking is most acute. Each new corridor is a live proof of concept. Each expansion reduces the argument that this is theoretical. Third, the tokenization wave hitting escape velocity. Tokenized treasuries on public ledgers have grown over 35% in the last 30 days alone. Franklin Templeton, BlackRock, Fidelity, they're not piloting anymore. They're scaling. And every tokenized asset that needs to settle cross-chain, cross-border, cross-currency runs directly into the problem that XRP was designed to solve. The catalysts are not coming from one direction. They are converging from 3 simultaneously. And when 3 independent tailwinds hit the same asset at the same time, the repricing doesn't telegraph itself in advance. It happens, and then the explanation comes after. The window is not closed, but it is narrowing. Here is the piece that rarely gets the attention it deserves. Exchange reserves for XRP are at multi-year lows. That data is on-chain, verifiable, and not subject to interpretation. When tokens leave exchanges, they are not available for immediate sale. That structural shift in supply accessibility is not a sentiment indicator. It is a market mechanics indicator. Simultaneously, whale wallets accumulated over 1.3 billion XRP during the most recent consolidation dip. That is not panic. That is predatory patience, the kind that happens when large players see a mathematical gap between current price and structural requirement, and they are willing to wait for the market to close it. The supply is fixed. The burn is real. The exchange reserves are draining, and the demand catalysts, regulatory, institutional, and infrastructure-driven, are all scheduled, not speculative. You are not watching a cryptocurrency consolidate. You are watching a bridge being loaded before the traffic begins. Let me leave you with this. The hardest part of being early isn't the waiting. It's the doubt that gets manufactured around you while you wait. The noise is not accidental. Confusion is the environment in which accumulation happens most efficiently. And the people generating the confusion are often the same ones benefiting from it. What separates the informed from the crowd isn't access to secret information. It's the discipline to follow structure instead of sentiment, to read the ledger instead of the headlines, to understand that the most important moves in any market happen in the quiet, in the filings, in the flow data, in the architectural decisions that don't make the front page. That's what we do here at XRP News Flow Signals. Every update, every breakdown, every signal that the mainstream misses. If this analysis brought clarity to the noise you've been navigating, subscribe right now. Share this with someone who's been asking the right questions but hasn't found the right framework yet. Drop a comment below. I want to know, what catalyst are you watching most closely right now? Let's talk in the comments. Stay rational. Stay positioned. The structure doesn't lie. And neither does the ledger. Catch you in the next one.